Welcome to this insightful journey where we unlock the mysteries of the 4 best dividend ETFs to buy now: VOM, PGX, HDV, and NOBL. The world of investing is teeming with opportunities, and one of the most attractive ones is dividend exchange-traded funds, or dividend ETFs. Imagine a basket, but instead of fruits or flowers, this one holds a variety of stocks that pay dividends. It's a consolidated asset that allows investors to buy and sell a set of securities in a single transaction. Now, why are these dividend ETFs so important, you ask? Well, for starters, they offer the invaluable benefits of diversification. Instead of putting all your eggs in one basket, you spread them across multiple baskets. This strategy reduces the risk associated with investing in a single company. But there's more to dividend ETFs than just risk management. They also provide a steady stream of income. How? Through dividends. These are payments made by corporations to their shareholders, a share of the profits, if you will. So, not only do you get the potential for your investment to grow over time, but you also receive regular income along the way. It's like having your cake and eating it too. Moreover, dividend ETFs are an excellent way for investors to tap into the potential of the stock market without needing to be stock-picking experts. They can simply buy a dividend ETF and gain exposure to a broad range of dividend-paying companies. In the grand scheme of investing, dividend ETFs are the perfect blend of income and growth potential. They offer a strategic way for investors to balance their portfolios, manage risk, and generate income. Now, among the plethora of dividend ETFs available in the market, 4 stand out as particularly promising: VOM, PGX, HDV, and NOBL. Each of these offers unique advantages and opportunities for investors. Stay tuned as we delve into the specifics of each of these 4 promising ETFs. Let's unlock the potential of these power-packed investment tools together. Thanks for tuning in, viewers. If you're finding this content valuable, there's so much more to come, filled with even more amazing tips, tricks, and inspiration. Make sure you hit that subscribe button to stay connected with us and never miss out. And while you're at it, drop a comment below and share this video with your friends. First on our list is the Vanguard High Dividend Yield ETF, known by its ticker symbol VYM. VYM stands as a formidable player in the ETF market with a primary focus on companies that have high dividend yields. This means that the fund invests in companies that are known for giving back a significant portion of their earnings to their shareholders in the form of dividends. This can prove to be an attractive feature for investors who are looking for a steady income stream in addition to their potential for capital gains. But what makes VYM stand out even more is its low expense ratio. In the world of investing, every penny counts, and the fact that VYM prides itself on having one of the lowest expense ratios in its category is a testament to Vanguard's commitment to keeping investor costs low. This low expense ratio can make a significant difference in the long run, as lower costs mean more of your money stays invested, potentially leading to higher returns. Yet another pro of VYM is its broad diversification. Holding over 350 stocks, VYM offers investors exposure to a wide range of sectors and industries. This diversification can help to mitigate risk by ensuring that the performance of the fund doesn't hinge on the success of a single company or sector. However, as with any investment, VYM is not without its cons. One potential drawback of this fund is its focus on high dividend yielding companies. While these companies can offer a steady stream of income, they often exhibit lower growth compared to growth-focused companies. This means that investors may potentially miss out on significant capital appreciation in the event of market rallies. Another potential downside to consider is VYM's heavy leaning towards large-cap companies. This means that the fund's performance is inherently tied to the performance of these large companies and may not capture the potential growth and dynamism of smaller, more nimble companies. Despite these potential drawbacks, VYM still holds strong as a viable option for those who are looking for a steady stream of income and broad diversification in their investment portfolio. It's important to remember that investing is not a one-size-fits-all endeavor, and what works for one investor may not work for another. In conclusion, VYM offers a solid and steady option for those looking to balance out their portfolio with high dividend yield. It's a fund that has proven its worth over time, and with its low expense ratio and broad diversification, it continues to be a go-to option for many investors. However, as with any investment, it's crucial to do your own research and understand your own risk tolerance before diving in. VYM offers a solid and steady option for those looking to balance out their portfolio with high dividend yield. Next, we dive into the Invesco Preferred ETF, or PGX. This is an investment that has attracted a lot of attention in the financial world, and for good reason. PGX is a fund that focuses on preferred stocks, which are a type of equity that often pays dividends. These dividends can provide a steady stream of income for investors, making PGX an attractive option for those looking for yield. But what exactly are preferred stocks? Well, they're a bit of a hybrid between common stocks and bonds. Like common stocks, preferred stocks represent ownership in a company, but like bonds, they come with fixed dividends. This means that investors are paid a fixed amount on a regular basis, which can be a major draw for those seeking income. One of the key advantages of PGX is its focus on these preferred stocks. This focus allows the fund to offer a higher yield than many other funds. In fact, as of now, PGX has a yield of over 5%. That's a level of income that's hard to find in today's low interest rate environment. But PGX isn't just about yield, it's also about potential stability. Preferred stocks are generally less volatile than common stocks. This is because they have a higher claim on a company's assets and earnings. If a company goes bankrupt, preferred shareholders are paid before common shareholders. This can provide a level of protection for investors. However, it's important to note that PGX isn't without its risks. One of the key risks is interest rate sensitivity. Preferred stocks are sensitive to interest rates. If rates rise, the fixed dividends paid by preferred stocks can become less attractive, leading to a decline in their price. This could negatively impact the performance of PGX. Additionally, while preferred stocks can provide a steady stream of income, they offer less potential for capital appreciation than common stocks. This is because the price of preferred stocks is largely driven by their dividends. If a company's earnings improve, the price of its common stock may rise, but the price of its preferred stock may not. This means that PGX may not offer as much potential for growth as some other funds. In summary, PGX is a fund that offers an attractive yield and potential stability. It achieves this by focusing on preferred stocks, which pay fixed dividends and are generally less volatile than common stocks. However, PGX is also subject to risks, including interest rate sensitivity and less potential for capital appreciation. PGX offers an interesting option for those looking for yield and potential stability. It's a fund that can provide a steady stream of income in a low interest rate environment, but like all investments, it comes with risks. So as always, it's important to do your own research and consider your own financial goals before making an investment decision. Moving on, let's explore the iShares Core High Dividend ETF, also known as HDV. This fund is a compelling option for those seeking exposure to some of the market's highest dividend-paying companies. HDV is a part of the iShares suite of products, one of the most respected and renowned families of ETFs in the investment world. What sets HDV apart is its focus on high dividend yield stocks. These are companies that have a track record of returning a substantial portion of their earnings to shareholders in the form of dividends. This focus can provide investors with a steady and reliable stream of income, which can be particularly appealing in times of market volatility or uncertainty. One of the key advantages of HDV is its low expense ratio. In the world of investing, every penny counts, and the relatively low cost of owning this ETF can add up to significant savings over the long term. The expense ratio for HDV is just 0.08%, which is lower than the average for ETFs in its category. This makes HDV a cost-effective option for investors looking to tap into the high dividend yield segment of the market. Stability is another selling point for HDV. The fund's holdings are predominantly large-cap, blue-chip companies that have a history of stable earnings and reliable dividends. These companies are often leaders in their respective industries and have demonstrated resilience in various market conditions. This makes HDV a potentially less risky choice compared to other high-yield dividend options. However, it's important to note that HDV's focus on value and high dividend-paying stocks could mean less potential for growth. Value stocks are often mature companies with slower growth rates, and while they can offer attractive dividends, they may not provide the same level of capital appreciation as growth stocks. This is something to consider depending on your investment goals and risk tolerance. Another potential downside is sector concentration. HDV's portfolio leans heavily towards certain sectors, particularly healthcare and consumer staples. While these sectors tend to be stable and dividend-rich, Overexposure to any one sector can add risk. Diversification is a fundamental principle of investing, so it's crucial to balance HDV with other investments to mitigate this risk. In conclusion, HDV strikes a balance between high dividends and stability, making it a potentially attractive choice for income-focused investors. The low expense ratio is a definite plus, and the emphasis on large, reliable companies could offer some level of protection against market volatility. However, the potential for slower growth and sector concentration are factors to consider. HDV is a solid choice for investors looking for a strong yield and a focus on value. It offers a cost-effective way to gain exposure to some of the market's highest dividend yield stocks, and its stability could make it a worthwhile addition to a diversified investment portfolio. As with any investment, it's important to consider your own financial goals and risk tolerance before making a decision. Last but certainly not least, we have the ProShares S&P 500 Dividend Aristocrats ETF, abbreviated as NOBL. NOBL is a fascinating player in the world of ETFs. Unlike many of its peers, this fund specifically targets companies with an impressive track record of consistently increasing their dividends for at least 25 consecutive years. This focus means that NOBL is composed of firms that are not only profitable, but also committed to sharing their success with shareholders. This strategy has several key advantages. Firstly, it means that the fund is investing in stable, successful companies that have proven their ability to weather economic storms. The fact that these companies have been able to consistently raise their dividends suggests they have reliable revenue streams and strong financial health. This focus on stability and reliability makes NOBL a potentially attractive option for those seeking income in their portfolio. Secondly, the focus on dividend growth means that NOBL also offers potential for capital appreciation. As these companies continue to grow and increase their dividends, the value of their stock can also rise. Therefore, investors in NOBL can potentially benefit from both the income generated by the dividends and the growth of their initial investment. However, it's not all sunshine and roses. Just as with any financial instrument, NOBL also has its share of drawbacks. The most significant of these is the fund's relatively higher expense ratio. While the cost of investing in NOBL might not break the bank, it is higher than many other ETFs, which could eat into your returns over time. It's essential to weigh this cost against the potential benefits before deciding if NOBL is the right choice for you. Another potential downside is that by focusing solely on companies that have consistently increased their dividends, NOBL may miss out on opportunities in sectors or companies that do not traditionally pay high dividends. This could potentially limit the fund's diversification and expose it to sector-specific risks. Despite these potential drawbacks, it's important to remember that NOBL provides exposure to a unique blend of companies that combine the promise of both growth and income. This dual focus is relatively rare among ETFs, making NOBL an interesting option for a variety of investors. Whether you're a retiree looking for a steady income stream, a young professional looking to grow your nest egg, or someone in between, NOBL offers a unique blend of features that could make it a valuable addition to your portfolio. As always, it's crucial to do your homework and consider your personal financial situation and goals before making any investment decisions. NOBL offers a unique blend of growth and income potential, making it an interesting choice for a variety of investors. We've covered a lot of ground today in our exploration of these 4 promising dividend ETFs. We dove deep into the high-yielding VYM, the consistent performer PGX, the resilient HDV, and the aristocratic NOBL. Each of these brings unique advantages to your portfolio. Whether it's VYM's generous yields, PGX's stability, HDV's robustness, or NOBL's aristocratic dividends. Yet, while these ETFs indeed present compelling investment opportunities, it's crucial to remember that each investor's goals and risk tolerance are unique. Therefore, it's essential to consider these factors when choosing which ETFs to buy into. In conclusion, investing in dividend ETFs can be a strategic move to diversify your portfolio and generate passive income. But as always, it's essential to do your homework and align your investment decisions with your financial goals and risk tolerance. Thank you for joining us on this journey. Remember to subscribe, like, and share this video with others who might find it valuable. Until next time, happy investing.